Good afternoon, everyone. My name is Michelle Briggs. I'm with Strata, Texas. I'm the realtor for you, and thank you for joining us today on the Briggs and Heights Mortar Facebook Live. And today we have Vicki Cheairs. Cheers! I love it. She is originator loan officer with Reverse Mortgage Funding. And when I learned about Vicki, I specifically said, you have to do this. I don't even think she had a choice because it's something that I recently learned. And I thought, what amazing opportunity to educate you that are watching, those that are on the replay, about options that you have for yourself inside of this program. So I'm going to let Vicki share a little bit about who she is, and then we'll start getting into her business and the programs that we're going to talk about today. So welcome, Vicki.
Well, thank you for having me. I appreciate the opportunity today to share a little bit. As for myself, I've been originating since middle of '97. I'm a former military brat, 12 schools, 12 years, that kind of stuff. But graduated from high school and went to college here. So kind of a Houstonian now at this point. But I've been doing reverse now since 2008 exclusively. To me, it was just a benevolent option. After my introduction into lending, I'd done that for about 12, 13 years. But when I found reverses, I just fell in love with it. So I've just kind of been in reverse world, stuck there in reverse since 2008.
I love it. Well, one of the programs that you shared with me was the HECM. And people are like, HECM, what the HECM is HECM? So HECM.
Correct.
Is the program. So talk to us a little bit about that. What does HECM stand for, and what can it do for, and who is it for? Let's just start with who is it for?
Okay. The HECM for purchase, anytime you see the term HECM, which is home equity conversion mortgage, anytime you see those words together, that just tells you it's FHA. So the HECM for purchase is basically the reverse of a reverse, if you will. It allows somebody to use the reverse product different than how it was designed, backwards to the reverse. And it's for all of those clients age 62 and above, for our older Americans. Both parties must be 62. In the old days, we could do somebody with a 58-year-old wife, but we can't anymore. So now both parties do have to be 62, but it allows them to buy a home for a fraction of the price. It brings new buyers into the market in this period of time where we've got no inventory. Which should excite all realtors. And it brings new buyers into that market, but more than that, they become walking testimonials to all of us. When people do a reverse mortgage, they don't necessarily tell everybody, but when they do a HECM for purchase, they tell everybody. It's a beautiful product.
So tell us a little bit about it. So HECM, like I said, it's a reverse of a reverse. I mean, I don't know how much more you can really go into depth about that. I guess we talk about reverses and then go back to HECM, but that's what I'm saying. It's like, your mind you just kind of go like, what the heck is that? And I don't even know what it is. And it's going to be just too much to learn. So what are just some basic HECM guidelines or things for people to go, maybe that does work for me?
Well, I'll tell you what we do is we plug into our systems the buyer's age, their birthday, the value of the home they might be looking for, and then the prevailing rates that day. And then HUD tells us how much we can lend. So for instance, if we have a client that's out looking at a $300,000 house, I plug into the computer their birthday, the value of the home, current interest rates, and let's just say HUD says I can give that client $150,000. I put up my 150, or my company's 150, that's the lien. They put up their 150, that's their equity, right? And they close into a mortgage that requires 0 mortgage payments. So now you have a client who possibly just sold maybe a $200,000 home, or we have a homeowner that sold a $200,000 home, that maybe it's 30 years old and fixing it up isn't close to the grandchildren and they'd like to just move, right? They can sell that $200,000 house, take the proceeds from that $200,000 house and use, in this example, $150 to buy that $300,000 house and stick $50,000 back in the bank for their retirement and close on a brand new house that's going, or a new or newer home that's going to age appropriately for them in retirement with no mortgage payments. They still own the home. They still own the home. If years from now they sell that home, we are just there to collect our lien, that which we lent them plus the accrued interest, and the rest goes with them if they're moving or their heirs if they left us. We don't get the house. We just have a lien. And it's just a simple lien, just like traditional lending is. It's just a simple lien. We're just first position lien holders. That's all we are.
Yeah,
It just lets their money go so much farther. I mean, they get so excited.
I guess where my mind gets blown is that they have no mortgage payment.
Correct.
For as long as they live in that home, they have no mortgage payment.
Correct.
Now, granted, 50% down on a $300,000 house may seem like a lot, but however, what you were saying is that, look, if you're living in a house now and you sell it, right, you've got, let's say your proceeds are $125,000. So you take $25,000 out of savings, right? You get the house and you don't have a mortgage payment. Correct. So whatever income that you have coming in, you can put it right back to build back that 25 grand.
Yeah. Right? Because you have no mortgage payments, right?
You have a mortgage payment.
Right. Typically what we find is most of our buyers have 401ks. They have some wealth. They typically do. They have some wealth at that point. Most of them. But typically we find is they just don't want to touch the wealth. That's all. They just don't want to touch the wealth. They want to know what they can buy for what they have in their home, right? And so it's like they would sell that $300,000 home and go buy another $300,000 home, but they're not going to get a house as big or as nice as their old home when you're doing same price for same price, right? And plus they know their neighborhood and so forth, right? And they don't want to pull out wealth under management. But when they can take that $300,000 and now step into a $400,000 and do it for $200,000 possibly, or some fraction thereof, stick the other $100,000 back in the bank, they improve their financial cash flow position. They have more money in the bank, and they have a house that maybe they hadn't even been able to dream before that it might be able to be theirs. It just opens up the world to them. I had a client a couple months ago. He closed on a $359,000 house. He put down $153,000. And the only reason he did it was because he could sell his $240,000 house. And after he netted from the sale of his home, $153,000 is what it took to put him in a $359,000 house. Older borrowers need less than younger borrowers. It's just more of an insurance product. It's based on life actuarial tables. But around 60 to 70s, it's running about 50% right now.
Got it. I think it's a great program. I mean, I don't know. If you're retiring soon and you've decided that you want to retire to a lake house, then sell your house here in Houston and do a HECM, buy a lake house, take your proceeds, put it towards the 50%, and you're done. You don't have a mortgage payment. Oh my gosh. I can't wait until I get 62 now.
Our biggest hurdle is selling past it's too good to be true, because it is. It really is. I mean, people lean forward and they look at it. I always say, if they don't look at me like I have two heads, they didn't hear me. I need to say it again, right? Because it doesn't it sounds made up. It just doesn't sound real. And the other problem is there was only 132 of these loans done in the whole state of Texas last year.
Ooh, girl, I'm glad we are on the cutting edge.
Yes.
Having this. I love it. Okay. So we're going to move on to the reverse mortgage, because HECM is different than a reverse mortgage. And there's caveats to reverse mortgages as well. And we're going to talk about myths next. And you got to stay for at least hearing some of these myths. And they're so important to know. Now, tell us about a reverse mortgage.
Well, a reverse mortgage is the granddaddy of them all, right? And basically the reverse is the same thing, only now we're using the equity in the home that you already have. So you've got a $200,000 home, right? I plug into the computer the $200,000, the birthdays of my borrowers, the prevailing interest rate. And in this event, let's say that it's about 50% on the 60 to 70-year-old. And let's say HUD says I can make available to them $100,000, okay? So they're going to access $100,000, right, that they have no mortgage payments or requirements to pay back, right? If they have a mortgage balance, we're going to pay that off first, because we have to be in first lien position, right? So if they got a $40,000, $60,000 mortgage balance, we're going to pay that off. Now that's going to improve their cash flow right away, because they're no longer going to be making payments on that. And likewise, when they're no longer making payments, that oftentimes causes them to not have to pull down from wealth under management, right? So the whole thing is about preserving wealth under management, which is why financial planners are such a great trusted partner when it comes to the reverse mortgage, because it's about preserving that wealth under management. You have too many seniors that are pulling down payments, pulling money from their wealth for the purposes of making a mortgage payment. There's just no logic in it. I don't care if the interest rate is 1%. There's just no logic in that, that amortizations can show, are effective retirement plans, right? But the reverse mortgage just lets them access this money. The best thing about a reverse mortgage, and the one nobody talks about though, is the reverse mortgage will create a line of credit that grows at the same rate as we're charging them on the loan balance. So in that example, a borrower with a $200,000 house that we can make available $100,000, and let's say they have a $40,000 lien. So I'm going to pay off the $40,000 lien, but that $60,000, they don't have to take it. I'm not going to charge them interest on it if they don't take it. And that $60,000 effectively is sitting in the wall of their house because it's not in our bank account. It's not in their bank account. It's just in the wall of their house, right? But it's growing at the exact same rate as I'm charging them on the $40,000. So if the interest rate is 3% or 5%, it doesn't matter, because that line of credit is going to keep increasing, and nothing stops that line of credit from increasing in availability. It is possible for that line of credit to outgrow the value of that house. That's crazy to me. I always say, if you do nothing else and you have a paid for and you're 62 years old, just set up the reverse mortgage so you have that line of credit growing, because that line of credit is going to keep growing regardless of what happens to the value of that home. And it can exceed the value of that home. And you may never need it. You've got all the money in the world, right? But you might look out there and that $100,000 grew to be $250,000 over some period of time. And now you can help send a grandkid to college, or help a loved one get the care that they need, or take care of yourself if you're the last remaining spouse. It's just sitting there in the wall, and it's federally insured. Nobody can take it. If you do a HELOC at the bank, they can take it, right? It's not federally insured. My line of credit is federally insured. And I always say, if you ever look outside and you see a bunch of seniors, they're doing backflips, those are my clients, because I showed them all how to set up that line of credit. It's just, I love it. It just absolutely changes their lives.
Well, this is definitely something that needs to get out into the world.
Yeah.
More.
It's too hard to talk about this. Even our competitors can't say everything that the loan does on their 30 and 40-second commercials. And so it doesn't get enough airplay to get people to come to us and say, hey, what was that weird thing where I don't have to take any money, but I can still do the loan? It's just beautiful. Like I said, I've never seen a bad one.
Oh, I love it. Okay. So if you are just joining us today, or watching us on the replay, my name is Michelle Briggs. I'm a realtor with Strata, Texas. I always say I'm the realtor for you. My guest today is Vicki Cheairs. Cheers. I love that last name. She's a loan officer originator with Reverse Mortgage Funding. Now, we talked about a HECM. You're like, what the HECM is HECM? It is a program that we just talked about. So rewind, go back and watch the beginning of this. Or even better, hashtag RMF below. That is your call to action. Hashtag RMF below, and Vicki will reach out to you directly to have a conversation. She is not a pressure sales rep. She is someone that wants to share this knowledge that clearly we don't know enough about in Houston or in the state of Texas for that matter. So use her as a resource. So we talked about HECMs and we talked about reverse mortgages. So those two opportunities, she is your go-to person, hashtag RMF below, and Vicki will reach out to you directly. Now, this is a really important piece of this conversation, is the myth or the myths, right? 2, 3, however many's out there about a reverse mortgage, about the HECM. Like, tell us a couple of myths that you hear consistently or know that's really out in the world for people that just don't understand or don't know about the programs.
It's our biggest obstacle is what people think they know about the reverse products. Number one is we don't take the house. Can we take a house just like a traditional lender? We can, but think of it this way. The reverse mortgage requires 0 payments. for the HECM for purchase or the reverse mortgage, it requires 0 payments. So if it requires 0 payments, exactly why would the lender ever take the house? I mean, non-payment of property taxes, homeowners insurance, or HOA. That's it. The same things that can cause you to lose a paid-for house can cause you to lose a house with a forward lien or a reverse lien. The difference is the minute the client says, you know, the reverse took my house, we all go, oh, the reverse took the house, right? It wasn't the reverse. It's not the reverse. The reverse is federally insured to not do that, right? It's you didn't meet the requirements of the loan. So that's the biggest one we always have to get past. The other one is that it's a loan of last resort. This is not a loan of last resort. Back about 4 or 5 years ago, we had no underwriting guidelines. All you had to do was a driver's license, social security card, and proof that you had homeowners insurance, and you could qualify for the loan because you're not paying us back anyway, right? But the truth was people kept going on TV saying the reverse took my house. And because they kept going on TV saying that reverse took my house, the other one that was happening was clients wouldn't pay those property taxes, right? Well, the lenders didn't want to foreclose on them. So the lenders that were debts less than $1,500, right? So some of the lenders were paying the debts and saying, pay me back, borrower. But HUD basically said, you cannot pay the property taxes for Michelle and not pay them for Vicki. You know, it's a government loan, insured loan. What you do for Jim, you have to do for John, right? So they stopped the lenders from doing that. The lenders then said, well, HUD, you're going to make us foreclose on that borrower for non-payment of property taxes, but you never ever let us even look to see if they ever had a history of paying property taxes. Well, now the bad news is we look. And we will split the atom over what day you paid your property taxes. And we do collect all the documentation of a forward mortgage with all the caveats of slicing atoms over what day property taxes, homeowners insurance, and HOAs were paid. But it's now we look, and unfortunately now there are people that we can't help. Whereas before we could help almost everybody. Now there are people that can come to us and we can't help them. Back then I called it the benevolent loan because I could help everybody. But even then, that loan of the last resort, I maybe got one a year, you know. Now that person that was my loan of last resort that made me go to bed at night thinking, oh my God, I have angel wings today. I did something wonderful. You know, I can't help that person. And so that's unfortunate. But the great thing is we did get out of the news. We don't hear reverse mortgage taking the flack anymore since we started these more stringent guidelines, you know. So good news, bad news, we're not in the news anymore. Bad news is there's now people that we actually have to say no to. And those of us that have been doing it a long time, we're not really big fans of that, but we also are thankful we're not in the news every day.
So, right, because you don't take the homes away. Right. There's other determining factors that do that, right? That create that, because as you said, if you don't have a mortgage payment, how do you get foreclosed? Exactly. You know, standard deeds of trust has the, you know, foreclosure clause. Obviously the deed of trust is no pay, no stay kind of thing. But this is different.
Yeah, this is pay your property taxes. Just keep up the lines of the loan. You know, the thing we asked you to do, just keep that up. You know, and they would do it anyway on a paid for house. So it's not any different for most of them than what they've already been doing in their previous homes or in their current homes. So.
Right. Well, okay, it is Tips Tuesday. So what is our tip for today?
My biggest tip, honestly, is to just wish everybody would give themselves the opportunity to learn more about this product. Don't believe what you think you know. It costs nothing to let us run those numbers for you and see exactly what the benefit could be for either yourself, your loved one, or a client or friend of yours. But the biggest one, again, Tips Tuesday, give yourself the opportunity to learn it. Learn it. Call us and ask us. Don't rely on reading the internet. Call us and ask us. Nothing shows this loan better than an actual loan scenario run out that shows your exact situation. In fact, I always say the reverse mortgage is always the reverse. It's exactly the same no matter who I talk to, but it's different between you and me because you're a different age than me. We're at different home values. We have different loan balances. We have different other goals in life, right? Can the loan meet those requirements? And that's what we're out to help you do.
All right, you guys, hashtag RMF below to have a conversation with Vicki to see what it looks like. Look at your financial future. Right? Are you currently in a home that you really want to get out of, but you don't want to get out of because you don't want to take on a new home and a new mortgage payment? So just hashtag RMF. Give Vicki an opportunity to share her knowledge, to grow your knowledge about the possibilities of these programs or these products that may help you and your family's financial future. Right?
Right.
Yeah. So you guys, thank you for watching Briggs and Mortar Heights Facebook Live. Michelle Briggs, Strata, Texas, Vicki Cheairs, Reverse Mortgage Funding. Always say, follow me on Facebook and Instagram, and also the fourth Tuesday, because the first, second, and third Tuesday, we do the Tips Tuesdays, just like this one. However, we're creating starting this month. On the fourth Tuesday of each month, we are going to have listings, loans, and lattes with Jonathan Coaster with Envoy Mortgage. You guys have a great